given you a little breather. I hope you've come up with some interesting questions. So settle in. And I'm going to ask the first question because as I watched this, I wanted to ask a question as though we had somebody here who was a critic of the Fed action. And I think the question I'd like to ask Eric is the following. Can this really work? You know, there are a number of economists who think that you can push hard on this one, but this is not going to work. We either should do nothing, if you're, I guess, Mitt Romney, or we have to find some way of getting fiscal policy, and that fiscal policy is really the lever we need. And that it's wonderful you're trying to do this in the absence of fiscal policy given the logjam in Washington. But how hopeful are you that this can work unless we also get some fiscal policy stimulus?
So I would agree with the assessment that getting the appropriate fiscal policy would always be the right thing to do, particularly—
Tell people what fiscal policy.
I'm sorry.
Government spending and tax policy. So the federal government spending more or taxing less, or it could be state government, it could be local government, but it's focusing on a government solution. So if you look at periods where rates are really low, it tends to be a period where many economists would argue that fiscal policy will be particularly effective because you'll spend a lot more, but you won't cause rates to go up. In fact, Larry Summers may have talked a little bit about this when he was here, that he's been talking about, gee, if you're thinking about investing 5 years in the future, but you can borrow at a very low interest rate, let's start doing more of those expenditures now. Well, that's in effect what the Fed's doing, not so much for the government, but for everybody. So if you were, it's taking some of what you might have done in the future and bringing it up because it's really low cost. So Larry's made the point that this is a perfect time for infrastructure investments. And I think that probably is right, that given the very low interest rates, if you think you need to fix a bridge 3 or 4 years down the road, and you can do it at a much lower interest rate, this would probably be a pretty good time to do that. But the same logic occurs at a college like Northeastern. If you're thinking about building an additional dorm sometime in the next 5 years, but right now you can borrow at a very low interest rate, you can say, normally I want to get all the wealthy alumni from this school to be able to contribute first, so I don't have to borrow any money at all.
Could you repeat that again?
Maybe I don't want to wait for 5 years. Maybe I can do it now, take on debt that doesn't have a very high interest cost, and then raise the money afterwards to retire the debt. So a lot of the things that we're doing actually is getting people, households, governments, everybody, to try to move up some of the decisions that they might have otherwise deferred to further out into the future. So I agree with your assessment that actually government might benefit from this low interest rate policy, but I disagree that it would be only government that could benefit from this very low interest rate policy. I actually think households could be helped. I actually think firms can be helped. And I think the overall economy could be helped. I wouldn't be advocating for this if I didn't think it could really make a difference. So I think it is an important policy. I do, though, also realize that there are limits to how much of an impact it can be. And we're not going to be offset really bad fiscal policy. We're not going to be able to offset if really bad policy decisions get made in Europe. But I'm hopeful that that won't happen. I'm an optimist. I'd like to think that as we get to the end of the year, regardless of who wins the election, that we'll get a willingness to work together enough to be able to come up with a rational fiscal policy, and that's kind of my hope for Europe as well. They've taken some initial steps. There have been some improvements in Europe relative to where we were, but clearly on both those issues, we're not where we want to be. That could, if the wrong decisions are made, have a big impact on our policies. But I think even if the things that just kind of tread water in these other areas, I think monetary policy can actually help. It'll get the employment situation better than it otherwise would have been.
Barry, can I ask a question before we go to the audience? We've had some pretty good news recently in the housing area. And
Eric, pretty good news recently in the housing area, including what seems to be a rebound in lower cost properties, which are the ones that really got killed with the housing bubble and foreclosures. Any relationship between that and the Fed's action? Or, and if so, what was it? Or what is it?
So I think that there are times where if you think that housing prices are going to keep falling very dramatically, it doesn't matter how low the cost of a mortgage is. If you think it's going to be much cheaper in 6 months to buy that house, and because it's a leveraged transaction, if you're putting 20% down, that means the price going down quickly erodes your capital put in. So if you really think housing prices are going down, there's not much that we can do to the cost of funds that are going to offset that. So the fact that we're starting to see some traction in the housing market, I think is exactly what makes this policy work at this particular point in time. Focusing on mortgages at this particular time, when prices are starting to go up and interest rates are artificially being pushed down by monetary policy, really provides a great opportunity. So I have a daughter who's just graduated from college. She's living in Brighton. If she thought she was going to stay there for a long period of time, given what she's paying in rent, there would be a real logic to her actually purchasing a place like that. Now, she doesn't know where she's going to be, so for her it may not be the right time. But if you're somebody who's pretty certain about you're going to be staying in Boston for a reasonable length of time, and you look at the difference between renting in Boston and purchasing a property, prices have come down, but they're starting to go up, rates are quite low. I think it really is a good time for people to be investing, and I think we're starting to see that, and it's not just in Boston. There are many markets around the country where that's true. And I do talk to people kind of in the hedge fund private equity space. Many of them are going and buying large tracts of homes in some of the most depressed areas of the country. They stopped doing that because they can't get the rate of return they're looking for. That's great news. That means that prices have already appreciated enough that they can't guarantee that they're going to get the price increases that they want. It's starting to see recovery in places like Phoenix and places in Florida, places in Nevada, where they really got badly hit, but there has been actually a stronger rebound in the various sand states that got hit much harder than places like New England.
Let me, if I might, Eric, just add a little to this. As a matter of fact, I think some of you know that every year the Dukakis Center for Urban Regional Policy produces the Greater Boston Housing Report Card. And our current report card will be out on November 14th, the week after the election. But I just happened to look at the latest numbers that came out just yesterday from our friend Chip Case and Bob Schiller, the famous Case-Shiller Index. And indeed, since January, all 20 of the markets they follow have had a beginning of a recovery in their prices. And as you said, Eric, they're actually recovering faster where they fell so rapidly. Las Vegas had a 62% drop in their home values from the peak. And we're seeing it here. It's a little slower here in Boston, but for precisely the reasons you suggest, a lot of real estate agents are going around. We work with the Massachusetts Association of Realtors, and they're telling young people, you may never see prices lower than you're seeing them right now because they're starting to rise. And you may never see much lower mortgage rates than you see right now. So near the beginning of your talk, you mentioned this is precisely the time to see that. And the good news on that is there's a secondary effect, which you also alluded to, which is that as people's home values start to rise again, particularly those people who may have been underwater, where the value of their home was less than their mortgage, they begin to feel a little wealthier. It was precisely that massive wealth effect that made this Great Recession so long indeed. If people begin to get a little bit more confidence that their asset is worth more, their major asset, and of course for most of us, our home is our major asset, that has this secondary impact of also probably adding a little bit more to consumption. Maybe this is the time we can trade in that 5-year-old car and get a good Chevy, Ford, or Chrysler vehicle. Another question? Over here in the middle, if we could. Straight down that road. Thank you. Please tell us who you are and what you do.
Holly Wilbert. I work at a biotech investment firm on the administrative staff. There's been a lot of discussion about the feedback loop of the liberal side and the conservative side of the discussions that are going on in the country. Is there anybody that you believe for the last 5 to 10 years was telling us things we should have been listening to in terms of what we were doing wrong as a country to get us into this place?
So I'm not going to pick a political figure because the Federal Reserve is very nonpartisan. I do think there are economists, and Schiller was actually one of the economists that was focusing on the fact that housing prices were going up very quickly and that he was skeptical that they would continue to go up and that if they came down, it would have a broader impact. So I think his work actually has been very effective. Housing played a very significant role in this entire crisis. There are a number of people who've done work looking at kind of international shocks and how those get transmitted around the world. I think that's very important work, that we are a much more integrated global economy. I'm still struck by the tsunami where I was in Thailand a little while ago, and they actually produce a lot of the auto parts. And in particular, there's certain things that they only produce in Thailand, and there's certain things they only produce in Japan, even though there's a global network. When it floods in Thailand or a typhoon in Japan, it shuts down production worldwide. So shocks that would normally have not occurred in a way that would be transmitted globally are now transmitted globally. So people that are doing work in that area, I think, is really important work as well.
Another question? How about over here? We'll get around to your side.
David Casaldi, retired biotech executive. The Federal Reserve's balance sheet has been expanded originally with a lot of short-term securities, which didn't incur an interest rate risk. But as the Fed moves into Operation Twist, long-term securities, and now QE3 mortgage-backed securities, they're dealing with long-term securities which have a significant interest rate risk. If interest rates should go up, the value of those securities on the Fed's balance sheet would go down perhaps significantly. I don't know whether that is a risk and whether it is a risk, but is it easy to manage, or is that one where there might be difficulties in managing that risk?
So as you point out, when you buy one reason that monetary policy tends to work in the short-term interest rates is for precisely the reason that you say. We tend to buy very short-term securities, we hold them to maturity, and there's not much interest rate risk. So that's normally why we focus on short-term interest rates. When interest rates get to zero, we don't have that option, so we have to buy longer-term securities if we want to have an impact. Now, we've been turning a lot of money back over to the federal government, and the reason is because when we create reserves in the system, we pay interest on reserves of 25 basis points. When we buy a mortgage-backed security, it's for substantially more than 25 basis points. The difference between those two, we keep paying back to the government. Now, if we get to an environment where the short-term rates rise very, very rapidly, and we were choosing to sell those mortgages or sell those treasury securities, you're exactly right that there could be a capital loss. The purpose of monetary policy is to get the right macroeconomic outcome, not to try to make money, and certainly not trying to lose money. Our projections are that under most normal circumstances, we will continue to be turning money back over to the US Treasury. And unlike a normal company, we can hold things to maturity even when they are very long-term securities, which is one reason why we use book accounting, not market accounting at the central bank, is because normally we hold everything to maturity so that the interest rate risk actually isn't all that relevant. So could we tighten policy without selling securities? The answer is yes. Our balance sheet is a completely separate decision from whether we raise short-term interest rates. So this may be a more technical answer than you wanted, but we have the ability to raise short-term interest rates even with a very expanded balance sheet through a thing called interest on reserves. So if we start raising that rate, other rates are going to follow along with that. So we have the ability to tighten policy where it's appropriate while not selling some of our assets. Now, we may choose to sell assets, and more than likely we will be selling assets. One of the advantages of mortgage-backed securities is that they have a relative to a long-term treasury bond, a shorter duration. What do I mean by that? Well, if you buy a house and in 6 years you decide you want a bigger house, and you're paying down your mortgage, well, that's paying down a mortgage-backed security. So mortgage-backed securities, when people move, when people die, when people switch jobs, all those things cause people to move out of the home that they had the original mortgage with. That results in a repayment, including a repayment if we're holding a mortgage-backed security. So one of the advantages of the mortgage-backed security portfolio is it is kind of self-liquidating to some extent. And so if interest rates stay fairly low for a while but then start going up, we'll see some of that self-liquidation shrinking naturally, and we just stop reinvesting securities, and that would start shrinking our portfolio more quickly. But you're right that there is some interest rate risk. So this is not a riskless strategy. It could potentially, if we had very rapid increase in short-term interest rates, the most likely event for that is that we start to grow really strongly. In some sense, that's a problem I'd almost hope that we have. So it is a risk, though, and you're highlighting an important one.
Let's go around over on this side over here. But up there, then we'll come up to the front.
How do you, Doug Pope, Boston, I'm in the energy business, energy efficiency and renewable energy. How does the balance sheet of the Fed intersect years down the road with the national debt and the medical expenses that the baby boomers are going to be expending in the upcoming future? So when do you anticipate paying down, selling off your assets? Or is there a level which you think you can maintain that you don't have to bring it down to the 800 or the million that you had before? So are you going to retain that large asset base, or are you going to sell it off? And how's it going to intersect with the other expenses we have coming up?
So monetary policy in some respects is a little independent of some of these other actions. So fiscal policy and monetary policy, our decision whether or not to sell assets is not really tied to what's happening with the federal government, and it's not really tied to what's happening with other expenses. It's really a decision about, are we getting the right outcome for inflation and unemployment? And so regardless of what's happening with fiscal policy, regardless of what's happening with, not that those things are unimportant, and they may be affecting the macroeconomy, but our focus for buying these assets is to impact the economy overall. So the time that we would start selling those assets is an environment where the unemployment rate had come down and where inflation was starting to go up. At that point, there are a number of ways that we can decide to slow down the economy. So let's imagine that we had a situation where housing prices not only went up, but started to go up very, very rapidly. Let's say the rest of the economy was improving, but housing market was really taking off. Well, that might be a time where you'd actually want to steepen the yield curve and slow down the housing market. In that kind of environment, you might not choose to raise short-term rates. You might decide to sell your mortgage-backed securities and cause the yield curve to get steeper. So it partly depends on what are the conditions in the economy when we decide that we want to raise rates and what's happening in all these various markets. So the exact strategy we pick is probably going to be dependent on economic outcomes. And we fully expect that we will be selling both the Treasury securities and mortgage-backed securities over time. But it's tied to economic outcomes. It's not really tied to these other factors.
So number one, do you feel that you can sell your assets at value? Or if you take a haircut, if you take a loss on those assets, how does that affect your balance sheet?
So the difference between a balance sheet and an income statement. So when we sell an asset, our assets do go down. If we have a loss, then that is a loss to net against our gains. As I was saying, right now it's 25 basis points and we're investing in things that pay a lot more than 25 basis points. So there's a pretty big spread right there. We're going to continue to get that spread until short-term rates start going up. So if we're right in mid-2015 is the date that short-term rates start going up, there's going to be time where we can stop investing and let things start coming down. So that's one reason why under many scenarios you wouldn't take overall a capital loss. You might take a loss on some securities when the interest rates go up. But it would take a fairly rapid increase in short-term interest rates to be in a situation where we wouldn't be turning money back over to the government.
Bob Culver, and a teacher here and an employee of Michael Dukakis. How many years ago?
Many.
Many.
And where are you now, Bob?
I am at Sasaki, managing director of global planning and design firm, but was the president of the Massachusetts Development Finance Agency, the Bank of the State. I want to raise a controversial point, I guess, which plagues me, so I might as well share it with Eric because we've had some of these discussions. One way of interpreting all the slides we've seen is to say that to say the least, monetary policy has to be frustrated with itself, and or possibly has proven to be somewhat of a failure. And if you take that approach and you say, well, what's going on? How come all of these great minds are making efforts at monetary policy to affect employment, but it's not really happening? Are we really getting an understanding of what's going on? And my sense has become that we really have not thought enough about the means of production, not to sound Marxian, but if you want to take it. And that is that technology is now substituting for labor at a rate that we really don't understand, similar to the way in the chip business and technology business until Professor Moore came along. We didn't really understand how it was that we could be outdating chip theory as quickly as we can, with so much more capacity. I am more and more convinced that there are no net new jobs being created for dollar of capital being expended. A simple example being that 34 years ago in this state, if you spent $1 billion, you would have been called Digital Wang or Prime Computer. That $1 billion would have represented the plant. You would have employed about 7,000 people. That's the way it would have looked. Fast forward to Bristol-Myers Squibb and Evergreen Solar being built in Devons. Bristol-Myers Squibb, the largest plant of its kind in the world, and Evergreen Solar, 3 football field long, huge plant dealing with the new industries of solar panels and biotechnology. Together they spent about $1.4 billion in capital, and they got 1,200 jobs between the two of them. And then fast forward into East Cambridge and spend another $1 billion, and maybe you get 500 to 700 jobs, and basically they're in clean rooms and they're in laboratories, and they're dealing with people, as you wouldn't know, Eric, who are generally PhDs or MPHs of like high level. So that $1 billion has decreased substantially in terms of the number of people that, or at least the case could be made, that it employs, and would imply to get the same number of jobs we got 30 years ago, we'd have to spend 7 to 10 to 12 times the capital that we're spending today. Do you believe there is any credence to that argument?
So there definitely have been productivity gains, particularly in the manufacturing sector. And you're definitely right that capital is playing a much larger role, particularly in the manufacturing sector. To have that explain the Japanese situation, you have to explain why all of a sudden there was a big shift between labor and capital in 1990 that occurred in Japan that didn't occur anywhere else in the world. Because everybody else didn't came in 1990. And for it to explain the United States, we were doing perfectly well until 4th quarter of 2007. There's been a lot of technology improvements all through that period. And so the fact that there's all of a sudden shift in 2007 and 2008 to a much higher rate of unemployment would seem to say that it's not so much a structural story with productivity, but might be a broader story tied to demand. So it's not that that isn't a factor, and it's certainly a factor in the manufacturing sector, but there are many other sectors in the economy. Our service sector has become much more important. When you see houses being built, when you see commercial real estate being done, it's still being done by the kinds of workers that were doing that before. So you're starting to see cranes around Boston. You're also seeing parts of the country that are doing reasonably well. We're not quite 2 percentage points below the national average for the unemployment rate. If you go to Vermont, New Hampshire, you're already seeing an unemployment rate that's pretty close to full employment. There are other parts of the country where that's true. So it certainly seems in parts of the country we're starting to get enough improvement that you're seeing it close to full employment. So I agree with you that there is a trend in productivity, and that's a positive thing. It does mean that we have to shift our labor force so that some of the manufacturing jobs that were very labor intensive will not be as labor intensive before. But I do think in a dynamic economy there will be shifts in the labor force, and there'll be some adjustments that have to be made. But by and large, I actually think the data is more tied to a shift in demand that occurred in 2007, 2008. We saw across all industries the unemployment rate go up. Across all age groups, the unemployment rate go up. That doesn't seem like just a productivity story. That sounds like a real big shock from the financial sector that caused everybody to pull back at the same time. So I still think there's a role for monetary policy. As you point out, if it's all coming from productivity in the manufacturing sector, there's gonna be a limited ability for monetary policy to have a big impact. But I actually think that the problem is broader than just the productivity and manufacturing. So it's not to deny your trend, but it's just to say I think there are plenty of other margins for which the Federal Reserve can be working on.
Just a quick, so therefore, you would believe that regardless of the means of production, full employment is a possibility if we apply monetary policy and fiscal policy in appropriate ways. That the means of production is not a negative drag that cannot be fixed by fiscal and monetary policy.
Means of production can be very important, but I think that monetary and fiscal policy, appropriate monetary and fiscal policies will get us back to that dotted line that I showed.
If I could, Bob, because Bob and I have talked about this issue of technological unemployment at length, and I'm somewhat sympathetic to it, having grown up in Detroit.
And that's taken a long time.
That's taken a long time. But I have to tell you, we just released, some of you saw it, a major report that came out of the Dukakis Center on the manufacturing sector. We released it with Governor Patrick and the Lieutenant Governor and Secretary Bielecki at a small firm down in Avon, AccuRounds. And one of the things that really shocked me, surprised me in a good way, was that since 2009, our best estimate using the Bureau of Economic Analysis data is that the manufacturing sector in Massachusetts, which still employs 250,000 workers, increased its annual productivity at a rate of 8.7%, which is 5 times higher than the rest of the economy in Massachusetts. Nonetheless, there was no job loss at all. And the reason is that productivity increases are making it possible for these firms, we had 60 CEOs who testified to this, to begin to, instead of outsource, insource, bringing back production here, and particularly as labor rates go up, transportation costs are high, it's possible to bring jobs back here so that at least over the last 3 years, and one of the only 3-year period of times when we did not have a decline in manufacturing employment, the increase in revenue is large enough to offset the productivity gain effects on employment. And in fact, although I don't believe in point estimates, the other day we got what looked like bad news. Unemployment rate here in Massachusetts went up 0.2 point to 6.3. In a month, we presumably lost 4,800 jobs. Those are from a sample, so I don't quite believe it. But it was interesting, of the 4,800 jobs that disappeared, or theoretically disappeared, about half of them were in education and health. Another third was in information technology. None of them were in manufacturing at all. Another question? Do you still have one back here? Please tell us who you are.
Hi, my name is Pat King Powers, and I'm an artist. I'd like to go to something pretty basic. We were talking about banks being too big to fail some years ago when all this started, and their culpability in the recession. And that sort of dropped, and I'm curious, if you're giving policy advice to the next president, would you advise the next president to do something about the size of banks and more regulation in that arena?
So in the DoddFrank legislation, there already are things that are trying to focus on the too big to fail. So there's a major effort to make sure that there are resolution plans that could actually be done for the large banks. We didn't have the legal infrastructure in 2007 and 2008 that we could try to do the change in the bank management and selling of assets in a way that wouldn't be very disruptive. One of the goals of DoddFrank is to try to make that much easier. Now, it's a little untried. We're still coming out with the rules and regulations. That alone won't solve all the problems, but I think that it actually was a fairly big step in making it easier to deal with a resolution of an institution without having to use government funds. In addition, we're in the process of writing, DoddFrank was a very substantial piece of legislation, and it basically left an awful lot for the regulators to do. So we're about halfway through writing all the regulations, but included in that is setting much higher capital standards than were occurring, so the likelihood that it occurs is a little bit less, and providing rules that make it much less likely that government funds would have to be used if there was a situation where a large bank failed. So I think that there are some very positive steps that have already been taken. I think there are going to be more positive steps that are occurring. I think everybody agrees that we don't want a situation where we have large institutions that can create the damage that have been done. There are a number of ways to do that. One of those is to raise capital high enough that you think it's a very unlikely event and you intervene much earlier. And if necessary, you intervene in a way that redistributes the assets without having the big impact on the economy. So I'm fairly hopeful that we've made some pretty good strides on that. I'd say some of the biggest issues with that are large global banks. So when you think of a bank being too big to fail, and you think of an organization that's in 100 different countries, so it's not just US banks. We have very big foreign banks in the United States. And so if a foreign bank has a problem, it can have a big disruptive effect potentially on the United States. A lot of our discussion has been domestically focused, but we're in a global world. Increasingly, the largest banks are global institutions. There's a lot more coordination that needs to occur among global regulators to deal with issues across borders. I think we're doing a better job with that, but I think we need to move that along much further than it has occurred today. So I think there's some positive steps that have already been taken. I think there are more positive steps that are going to be occurring over the next couple of years to deal with some of the concerns that you've raised.
Right here.
Hi, President. I'm a multi-field university student, and I study economics, and I'm very glad to see you on the real economics. So I'm very curious. I'm sorry I have 4 questions, but it's very simple to answer. I will remind you if you forget the question. Sorry. So the first question is, as a president of the Fed, of course you value very much about monetary policy, but basically are you a Keynesian or you're a classical economist? The second question is
he's a tennis player.
not a good enough one though. Okay. Second question is many people criticize Greenspan as Greenspan is the cause of this financial crisis because of his non-low interest policy. So do you think the Fed or the chairman of the Fed is important enough to decide U.S. economy, or do you think it is just what he explained for himself that, oh, it's not my business, it's business cycle. It cannot be predicted. So do you think, how do you think the role that the Fed play in U.S. economy? And the third question.
Why don't you stop there so I can get it? Otherwise I won't remember them.
Oh, okay, I will remind you. Okay, sorry. Can I?
No, that 2's enough because I've got to get one more question. We're almost out of time.
Oh.
So
okay. We usually only allow 1 question per customer. You got 2. You got twice for the money.
I actually don't think labels are all that useful. If I were to characterize myself, it would be maybe a little bit more in the activist bent, so that I don't think we should stand by if there are serious problems going on in the economy. I think we should try to address them. So that's not Republican or Democrat. It's not really Keynesian or monetarist. It's saying that given the institutional situation that we're in now, I think there is a positive outcome if we take more aggressive action. I'm not going to talk too much about previous chairmen, but I will say that it matters who the chairman is, or chairperson is. So that I think, to Kathy's comments, that we're very fortunate that Ben Bernanke was in the seat that he was in during this crisis. And with a different person, we could have had a much, much worse outcome. So we're very fortunate that we had somebody who was so knowledgeable about financial institutions, financial markets, monetary policy, particularly in deeply distressed situations. If we had had a different person in that place and they hadn't taken aggressive actions in fall 2008, I have no doubt that we'd be in a much worse place right now. So I think it really does matter who's in that position, and people should take very seriously when it comes time to pick a successor, and I hope that's far out into the future, that it's a very thoughtful decision because it is an important decision.
Okay, but please.
No, I'm sorry. We're going to give you the last question right here. We'll get the mic. Again, remember to tell us who you are. Thank you.
Hi, I'm this fella's mother-in-law, and he's the one that.
Proxy question.
Take note, everyone. Bring your mother-in-law.
know who your mother-in-law is. Who are you?
I'm Taz Hussein.
I'm done over Tasha.
I'm Taz Hussein. I work in management consulting. And it's a question about assessing the impact of this latest action by the Fed. So as a thought experiment, let's assume over the next year we don't have any other major adverse shocks. Let's assume that there isn't any other substantial fiscal action that's taken. What would you expect to see in a year's time? How would we all know that this latest action has had impact? What are the indicators of that?
So the main indicator, and I'd actually take a longer time period than just next year, but assuming no negative shocks by 2015, I'd expect roughly ballpark 0.6% on unemployment, 0.7% on unemployment. We have a labor force of 150 million people. So it seems like a small percent, but when you multiply it by 150 million, you get a pretty big number. And so for those people that are unemployed, it really does make a dramatic effect, which is to say that we're going to get the unemployment rate down more quickly, but it still means to get to full employment, we're still talking about being many years away from getting back to full employment. When you're at 8.1 and you want to get down to 5.2%, you really need to grow the economy very, very fast to have that happen quickly. It's not going to happen quickly. It's going to happen more slowly than any of us in this room would like. But a couple of tenths every single year starts adding up and starts making a pretty big difference to that all those people that would be employed that wouldn't have been employed had we not taken that action. We'd also, I think, start seeing a more resilient housing market. I think there are other indicators that we'd see. We'd see a more resilient housing market than we'd otherwise see. We'd see some more exports than we would otherwise see. We would see some people consuming a little bit more than we otherwise would have. So some of the trends in terms of GDP would be growing faster than the 2% that we've been seeing. We'd start seeing growth that was, 0.4% higher each year, so that starts having an impact on the labor market. So that's roughly the magnitude of what I think this action would be. So I'd like it to be more powerful than that, but that's still actually very significant when you talk about an economy the size that we're in.
Well, Eric, I want to thank you so much. A very, very special occasion here at Northeastern, and I can't help but just thank you so much for joining us again, Eric. A few announcements before we move on. Let's see if I've got this here. Do I go the other way?
It's all at the end.
What?
It's all at the end.
It's all at the end? So next week, you won't quite get this. But you will get Kathy Bradbury, who's a wonderful friend of mine, a colleague of Eric's at the Boston Federal Reserve Bank, expert on social mobility, and you're also going to hear from me. And I have a reading assignment for you, very, very important piece of economics to read by the very, very famous, almost Nobel Prize-winning economist, Agatha Christie. The reading assignment is her novel, Murder on the Orient Express. And you will find that that is the most relevant reading for the presentation that I'm going to make next week about income inequality and social mobility. Agatha Christie, Murder on the Orient Express. You can get it on Amazon for $3.21. The other announcement is that if you look at the board here, the graduate student government here at Northeastern has 10 tickets to the Warren Brown #2 debate, which will be at UMass. We have now 8 tickets to the Warren Brown debate on Monday, next Monday at 7 o'clock.
6.
Now we have 6. But if you're interested, email Margaret Keaveney at this email address, and you may be the lucky winner of a ticket to see this debate live and in person at UMass Lowell. Thanks again for joining us. We'll see you next week.